to
Right.
Congress. It'll come out eventually at some point. But you have to ask yourself, $100 billion, really? Is it Buffett? I mean, is it
Yeah, that's what I
Bezos?
thought too.
Is it Elon Musk? Who is it? Whoever it is has very deep pockets. The fact we hear nothing about it leads me to believe that this is deeper than we think. And if you realize that we have been losing this race to the rest of the world, standing for delivery, bleeding dry the LBMA, literally to where in 140 years since they started keeping records, it's a 140-year-old exchange, that they have the lowest amount of silver that they've ever had there. 155 million ounces at the LBMA, which is the lowest they've ever had, but they trade 190 million ounces per day. They have a 155 million ounce float. But David Jensen, who I think you should have on your show, does as good of a job as anyone talking about the LBMA, says, no, 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 no. They trade 190 million ounces. Those are final posted numbers, but they've admitted to trading 10 times that amount during the day. They only post the final numbers. So in other words, he's saying they're trading upwards ends every day of 1.9 billion ounces, 3.5 times annual global mine supply,
Jeez.
15 times the float. The same thing. Right now, you have the head of the Japanese Metals Association. He was the guy that ran ICBC, the Chinese bank, on the Japanese exchange. He's a very smart man. I forget his name right now. That's irrelevant. But last week he came out and he said, look, there is no platinum on COMEX or in Switzerland, yet they're trading 3 million ounces a day in spot contracts that are deliverable. This is the game that is being played, that is being exposed by the rest of the world. This is why, for the better part of the first half of this year, the LBMA has said, yeah, we're a T+1 exchange, meaning T is a trade day plus 1 is settlement. The third day, the bar should be moving to your account.
Right.
But there's a shortage of manpower and trucks, we're told by the Bank of England. So it's T+8 weeks. We're sorry for the delay. That's got caught with your pants down and you're trying to source the metal at some point. So you're giving yourself an 8-week runway when it's supposed to be T+1. This is what's happening when rehypothecation is exposed through the delivery mechanism. No one ever stood for delivery, like I said at the beginning. Less than 1% in my entire career were people standing for delivery. And I always thought about it when Jim Sinclair said that. I'm like, yeah, fuck, how the hell is that going to happen? But it's true. If more and more and more of these large entities stand for delivery, the inability to cover naked short contracts becomes real and becomes existential. It's a threat to these banks. So at some point, these banks have to understand this, to know that they have been outed by the rest of the world who understands it. I'll give you an example. The grain exchange, the folks that are building the bricks, they developed a grain exchange. And the guy that's running it said, we produce and consume more grain than they do in the West. But we can't control the price at all. It's controlled on COMEX. But with the development of this grain exchange, that will change.
Wow.
Now, if you don't think they know what we're doing with precious metals, I got a bridge
they
to sell
do.
you.
Yeah.
And they're using it against us. If these sons of bitches want to suppress the price, the King Kong on Twitter, who's fantastic. I think he's one of the best out there. He says China's doing it too. Don't silver. They're suppressing the paper price in the West and going all around the world and buying from exchanges that do not affect price. Buy as much as you can, but the price isn't affect because you shorted it in the West where the price is listed, where the price is made, and then you buy it up everywhere else at subsidized prices, including going, as Vince Lancy says, to Mexico and buying up anything they can before it's even called silver, which he means doré and concentrate.
Right.
But they're doing the same thing in Peru, where they're going directly to the miners to completely disintermediate the marketplace and buying doré and concentrate and shipping it back to China for refining. Now, this is the number one producer of gold in the world and the number two producer of silver in the world. And yet they're going all around the world and buying doré and concentrate from miners directly to disintermediate the marketplace. If silver and gold was just an archaic relic of the past that meant nothing, and they are the largest producers, and why the hell are they flying around the world and buying gold and silver in impure forms, whether it be a sludge concentrate as a byproduct of the mining process, or the doré bars, which are impure bars that get sent from the miners to be further refined and purified? They're buying that directly from the miners, not letting it hit an exchange, buying it, paying double what the West will, and shipping it back to refine it themselves, because they understand this is a race. It is a race to accumulate rare earths, precious metals, farmland,
Yeah.
oil reserves, rare, everything you can think of, base metals, anything. And that's why China bought the London Metal Exchange, which is not the LBMA. It's the exchange that sells all the base metals like copper. Well, that might be considered precious. Let's say like lead, like zinc, tin. All of that stuff is traded on the London Metals Exchange. And then they're building warehouses in China to stockpile all of the contracts, the metal
Wow.
that are backing the contracts, but they own the exchange. See, they think much deeper than we do, and we think in terms of minutes. They're thinking in terms of decades, and they're positioning themselves for what ultimately is a race to secure the world's commodities before the shit hits the fan, whatever that is.
Right.
And they're succeeding, and they're doing it off of Comex. So I would leave you with one statement, and that is price is the ultimate tool of misdirection. They misdirect the public with price and rhetoric while they're able to pickpocket not only the LBMA and those that are pickpocketing the Comex. At the same time, they're going and buying the stuff before it even hits the marketplace all around the world, which is disintermediating the price, the marketplace, and the understanding of the marketplace to know just how much they really are buying it, which is far more important than price because it signals just how important it is
Right.
strategically to them.
When you ask yourself who's behind $100 billion worth of gold flowing into the US since November, it's a fair question. Buffett, Musk, some anonymous sovereign wealth fund? Whoever it is, the size alone tells you this isn't a hobbyist stacker. This is deep-pocketed, deliberate accumulation. And what's most fascinating is how quiet it's been kept. The silence tells you it's bigger than we think. Because if mainstream financial journalists smelled this scale of buying, they'd be camped out at Comex loading docks with binoculars. Instead, nothing. Crickets. And that's exactly how the insiders want it. The reality is that we've been losing this race against the rest of the world for years. Delivery demand is bleeding the LBMA dry. And now, for the first time in its 140-year history, the exchange that prided itself on being the deepest pool of liquidity is down to the lowest float of silver it has ever recorded, 155 million ounces. To put that in perspective, the LBMA reports trading 190 million ounces of silver per day. That means they trade more in a day than they physically have in the vaults. And that's the official posted number. Analysts like David Jensen point out that intraday, they churn 10 times that amount, close to 2 billion ounces a day. That's 3.5 times annual mine supply and 15 times the actual float. It's like a casino that only has 100 chips on the table, but lets gamblers write IOUs for thousands. As long as nobody has to cash out, the illusion holds. But now people are cashing out, and it's not just silver. Take platinum. The head of the Japanese Metals Association, who also ran ICBC on the Tokyo Exchange, came out bluntly. There is no platinum in Switzerland, no platinum on Comex, yet 3 million ounces trade daily in supposedly deliverable contracts. That's not trading. That's make-believe. The same game is being played across precious metals. And when delivery demands expose it, the excuses come. The LBMA now admits that while it's supposed to be T+1 settlement, trade today, bar shows up in your account tomorrow, in practice it's T+8 weeks. Why? Shortage of manpower. Shortage of trucks. Really? London is one of the most sophisticated logistics hubs in the world, and suddenly they can't find drivers? It's laughable. What it really means is they're scrambling to source physical bars in time, and that's because the float is gone. I used to hear Jim Sinclair say, if people ever start standing for delivery, the system breaks. For years, less than 1% of contracts did. It was a rounding error. Nobody bothered. Now, we're seeing 100% in some months. In August alone, the first 3 days saw over 20,000 contracts stand for delivery. $7 billion worth of gold. That's unprecedented. And the more entities do it, the harder it is for banks to cover naked shorts. This isn't academic anymore. It's existential. Meanwhile, China and the BRICS aren't sitting around watching. They know exactly what the West has done, using derivatives to suppress prices while physical trickled out. And they've copied the playbook, then flipped it. Chinese buyers are happy to see Western banks smash the paper price because it means they can scoop up real metal cheap outside the Western system. They've built grain exchanges, metal exchanges, oil settlement systems, all to bypass COMEX and LBMA price control. And when I say bypass, I mean they're going straight to miners. They're buying doré bars in Mexico before they're even called silver. They're buying sludge and concentrate in Peru. They're paying up double the Western bid because they don't want the ounces hitting the exchange at all. They want to disintermediate the marketplace. Think about that. China is the world's largest gold producer and the #2 silver producer. If gold and silver were truly barbarous relics, as Western economists like to say, why would the biggest producers be going around the globe buying additional ounces in impure form? Why would they pay more for doré, concentrate, sludge, metal that still has to be refined, unless they considered it strategically vital? They're buying it before it ever sees daylight on an exchange, refining it themselves and adding it to stockpiles. And that stockpile isn't for jewelry shops. It's for a monetary reset. This is why China bought the London Metal Exchange, not the LBMA, but the LME, the clearinghouse for copper, lead, zinc, tin, nickel. They control the plumbing for base metals. Then they built warehouses in China to stockpile the metal behind those contracts. They don't think in terms of day trades. They think in decades. They know this is a race to secure rare earths, farmland, oil reserves, precious metals, everything tangible, before the paper system breaks, and it is breaking.
We are digging up the easy silver and running out of it. It's all in the book. This includes gold too. The easy discoveries, the big deposits have all been discovered and worked out. Are we running out of wood? Can you regrow wood? Yes, you can. So building a house, you can grow the trees, you can build a house. So we're not running out of forests to build houses out of. Are we running out of silver? Yes. Take a look at the U.S. Geological Survey. Silver needs to go up. It is severely undervalued compared to other assets. And we don't need it to be a monetary metal again, for it needs to mean revert against these things. One of the reasons it hasn't yet is, one, there's a manipulation. Two, it's a byproduct of mining other metals. But as soon as we have a global financial crisis again, there's always a crisis around the corner. It might take 10 years to get here. It might take 2. The longest is a little over 10 years that we go between recessions. And when you look at where we are as far as the bubbles in real estate, in stocks, we're in the everything bubble, except it's the almost everything bubble. I point that out in the book. Gold and silver, measured against everything else, aren't in a bubble.
So yeah, I think the value proposition for silver is pretty clear in that case.
Yeah, the catalysts going forward are a steady march forward if there is no crisis and no monetary demand. They need it for electric cars and for solar panels and everything else. The projected demand far outstrips projected supply, and we're already in a deficit that's 5 years old. And so the only way to correct this and actually have enough silver for industry is for price to reduce demand as it goes up and increase supply as it goes up. And then it would get back into balance with everything else after a while, but it is severely undervalued. Okay, if there is another financial crisis, if there's a monetary event where people seek safe havens, people will rush toward, I've said this so many times. So like I said, your best investment is your own financial education. The book is only $9.99 if you get the Kindle. And I'm not I actually lose money on the books. I'm not making a profit on the books. It's just a whole bunch of factors that came together during COVID to cause me to have to make a much larger investment in producing that book than I would normally have had to have made. And so every time I sell a book, it costs me about $1 right now to sell a book. It's spreading the knowledge is the reason that I pay you $1 to read the book. Now the Kindle doesn't cost me anything so I probably make a little profit there by the time the publisher and Amazon and everybody else takes their cut out first. The book does answer all of these questions. And the thing is, if you use numbers instead of emotion for your exit scenario.
Let's start with Judy Shelton. Judy, for those who don't know, was Trump's pick for the Federal Reserve Board back in 2016. She literally wrote the book on gold-backed treasuries. And when I interviewed her, she didn't mince words. She said July 4th, 2026, America's 250th birthday, would be the moment Trump issues gold-backed treasuries on the long end of the curve. Not a vague hint, not a wink and nod. She said it directly, and the logic lines up perfectly with what we're seeing. Think about the sequence. Since November, the U.S. has become a net importer of gold for the first time in 35 years. Month after month, billions of dollars of physical are being pulled into COMEX vaults. Why? Because if you're going to revalue gold and peg treasuries to it, you need the gold here. You can't do it if it's scattered around London or leased out to Switzerland. You reshore it, then you revalue it. Then you issue zero-coupon, long-dated treasuries redeemable in gold. At a stroke, you solve three problems. You create demand for U.S. debt, you cap long-end yields, and you give yourself a fighting chance to reshore manufacturing under a devalued dollar. That last point is key. Trump wants a weak dollar. He's been saying it for years. Why? Because the strong dollar hollowed out American industry. Triffin's dilemma says if you're the world's reserve currency, you'll always run deficits. Dollars flood abroad, your currency stays strong, and your manufacturing goes overseas where labor is cheaper. You end up a financialized hollow core, running on Wall Street tricks instead of factories. That's where we are now, and the only way back is a weaker dollar plus low borrowing costs. How do you do that? You revalue gold. Jim Rickards has done the math. If you divided U.S. money supply by official gold reserves, fair value gold would be $24,000 an ounce. Even a move to $10,000 would vaporize 60% of the dollar's purchasing power overnight. Sounds catastrophic, right? But that's the point. Every $4,000 increase in gold's price credits the Treasury General account with $1 trillion. Revalue to $24,000, and suddenly you have $6 trillion to work with. The Treasury issues gold certificates, the Fed prints the dollars, the debt gets partially retired, and interest costs vanish on the long end. Meanwhile, manufacturers see a cheap dollar and zero borrowing costs and start investing at home again. Will it cause inflation? Of course, but that's the plan. Inflate away the debt while relinking the dollar to gold in a way that restores trust. You keep the short end funded with trillions in stablecoin issuance. Chase points, JP Morgan, Coinbase partnerships, all linked to 1- and 2-year treasuries. That's the sugar high that funds deficits in the near term. But the back end is anchored in gold. That's how you split the curve. Digital fiat at the front, hard money at the back. And guess what? The rest of the world is already doing it. BRICS nations aren't waiting. China's yuan trades on Basel III rails, backed 1-to-1 by gold. Russia's ruble, same thing. Settlement through SIPs, their cross-border payment platform, has already overtaken SWIFT in transactions as of this spring. Almost 5,000 banks are on board. Settlement in seconds, 98% cheaper, sanctions-proof, and imbalances can be settled in gold at multi-jurisdictional vaults in Shanghai, Moscow, Dubai, Riyadh. When Lavrov says, this opens to 90% of the world's population, he isn't exaggerating. BRICS Pay is going retail. Imagine a Brazilian small business swiping a card to buy parts from India, settling in digital yuan or rubles, with final settlement in gold. No SWIFT, no FEDWIRE, no dollar. That's the competition. And while Western analysts dismiss it as too small, the reality is that it's 75% of the world's population and growing. Now here's the punchline. The West is helping them. By smashing paper prices, by tolerating T+8 8-week delays, by running deficits that force more gold into the system, we are subsidizing BRICS accumulation. China doesn't need to bid silver to $100 today. They're content letting JP Morgan push it to 24 on a Friday close so they can buy Doré from Peru Monday morning at half price. They can wait. They think in decades, we think in quarters. Meanwhile, the insiders here aren't blind. Insiders are selling stocks like mad. Bezos dumped $5.7 billion of Amazon shares. Nvidia insiders cashed out hundreds of millions. Buffett sits on $500 billion in cash and treasuries. They see what's coming. And what they're not doing is piling into S&P ETFs with the retail crowd. Retail exposure to equities is now over 50%, the highest in history, higher than the dot-com peak. And retail exposure to metals? Maybe 0.5%, according to Rick Rule. Which side of that trade do you want to be on? Let me paint the timeline. By late 2025, insiders are fully rotated, out of equities into physical. By mid-2026, Trump is back, announcing gold-backed treasuries on July 4th. The dollar is devalued. Stable coins flood the front end. BRICS are already settling trade outside SWIFT. By 2027, we're in a dual-track world. West using a devalued dollar pegged to gold on the long end, East using yuan and rubles already gold-linked. Either way, gold is the common denominator. So where does that leave silver? In my opinion, as the generational opportunity. Gold is the monetary anchor. Silver is the leverage. Every cycle I've watched, 1980, 2011, in the stirrings now, gold moves first, then silver overshoots. Silver's supply-demand deficit is already structural. Russia is diverting 1,400 tons this year into military stockpiles. China is stockpiling. India's imports are at record highs. And the LBMA only has 155 million ounces left. They trade that in a single day. That's why I say sub-$40 silver is unsustainable. Once the dam breaks, once generalist capital arrives, you'll see triple digits. And when that happens, the miners will go berserk. Right now, gold miners are finally being rewarded for discipline. Free cash flow is exploding. Newmont blew out earnings. Agnico Eagle doubled. Wheatons and Francos are up 150% in 18 months. But the juniors? Still cheap, still starved of capital. When silver hits $75, you'll see what Doug Casey described, trying to siphon Hoover Dam through a garden hose. There aren't enough quality names. Money will chase a handful of stocks and multiply them tenfold. And that's when you'll see the public arrive, late, as always. But let me end with perspective. When the U.S. confiscated gold in 1933, it revalued from $20.67 to $35 overnight. Holders of gold saw an instant 70% gain. When Nixon closed the gold window in 1971, gold went from $35 to $850 in 9 years. When the Hunt brothers drove silver to $50 in 1980, it was equivalent to $200 in today's dollars. History doesn't repeat, but it rhymes. And the rhyme is this. Every time the paper system breaks, gold and silver don't just protect wealth, they reset the system. So yes, you'll hear mainstream analysts mock precious metals. You'll hear barbarous relic, no yield. Crypto is the future, but follow the flow. Follow the insiders. Follow the central banks. They're buying gold hand over fist. They're draining LBMA vaults. They're standing for delivery at 100% levels. And they're building the infrastructure for a post-dollar world. Price is misdirection, flow is reality, and the flow is screaming that we're on the cusp of the biggest monetary reset since 1971. So if you're watching this and wondering what to do, I'll tell you what I tell my clients. Don't wait for the headlines. Don't wait for the revaluation announcement on a Sunday night. Don't wait until CNBC says silver's up 15% in a day. By then, it's too late. You need to own real, physical, deliverable metal now. Because once this reset is public, it won't be available at any price. And when that day comes, the people who listened, who saw through the misdirection, who followed the flow, won't just survive. They'll be positioned on the right side of history.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.